if you're putting together your plans for retirement in 2026, whether you're doing it on your own, working with a piece of financial planning software, or if you're working with a financial advisor who's doing this for you, here are 5 common mistakes that I see a lot of people making when it comes to their retirement planning. Number 1 is using the wrong rate of return. And this could go both ways. Sometimes people are using too high of a rate of return, and that may not properly account for something called the sequence of return risk. So even if you do in fact earn that higher rate of return, whether that's a 7 or 8 or even a 10% long-term rate of return, that return is likely going to vary from year to year as the markets are moving through its cycle. So something called sequence of return, and that idea that some years may be a 15% positive or even a 20% positive, and other years though may be down 10 or 20%, or a major market correction that could be down 40 or 50%. And so using a lower rate of return is going to give us an ability to sort of plan for some of that sequence of return risk, and that idea that these returns are not going to be consistent over time. On the flip side of that, when we start talking about using a lower rate of return for our long-term forecast, that's going to be great for hopefully making sure that our trajectory is on track and we're doing all the right things. But if we use too low of a rate of return, some of those accounts may actually grow at that higher rate of return, and that could be a tax problem for us later. So when we're doing our planning, we may use a 5% assumption for the core plan to see where we're at with cash flow and what that long-term trajectory is. But we also may want to throw in a higher rate of return just to see what the balance, for example, of that traditional retirement account is going to be 10 or 20 years down the road as you start taking your required minimum distributions. And is that going to be a tax problem for you later? So you want to look at both of those, and there's 2 specific purposes for that. Number 2 is relying too much on Monte Carlo. So Monte Carlo sounds great in theory. What they do is they run thousands of different hypothetical situations looking at past markets and good markets and bad markets, and they randomize the returns of the market. And that may seem like that's a good way to account for what we just talked about there, that sequence of return. But what it may not be doing is, if you look at how the markets really move in actuality, they tend to go through cycles. So you get these bull markets and you get these bear markets. So you get a string of good markets in a row, but you also get strings of bad markets in a row too. If you think back to 2000 when the internet bubble crashed, and that lasted for 3 years, where the market was going down for 3 years, and then it took 5 years to recover. And then in 2008, just as it was getting back up to that same level, we went through the financial crisis and the market went down again about 57%. And again, took about 4 or 5 years to recover from that. So that was a 14-year stretch where essentially, if you look at the S&P, it was basically at the same point 14 years later as it was when it started that whole cycle in the year 2000. So if you go through one of those periods of time, especially if that happens early in retirement, that may be very difficult to recover from. And Monte Carlo doesn't always take that into account. So what we'd like to do instead, sure, Monte Carlo is great to get that number to see where are we at, just as a rule of thumb. But what we'd like to do instead is look at what is the withdrawal rate per year. We subscribe very heavily to that 4% rule, and if you're taking money out of an investment account, whether it's all in stocks or a mix of 60-40 or more bond heavy, about 4% per year is what that withdrawal rate is going to be for a good probability that money is going to last you for the rest of your life. So we can, in our financial plans, look at what that withdrawal is every year, and it might fluctuate a little bit based on income coming in and based on the expenses that you have and things like that. So you may have some years early on, a lot of people do, where it may go a little bit above that 4%, but then we want to see that long term we're staying within that 4% rule. And that's going to give us a good rule of thumb that money should last you hopefully for the rest of your life. The next one is going to be life expectancy. And we want to do a couple of things here. Number 1, we want to make sure that we're planning long enough inside of our financial plans. You may have some ideas of your own on what your life expectancy may be, maybe based on past family history and everything, but running your projections out to age 90 or 95, I think is a great thing. If you look statistically, the chances of, if you're married, you or your spouse making it to at least age 90, I think is about 25%. And a lot of people are living well into their 90s now. So you want to make sure that you have that built into your plan, that money is going to last. But the other thing you want to look at with life expectancy here is, as you're doing your projections, you may run a Social Security analysis, and it may say that you're going to come out way further ahead by delaying Social Security. But that may be going out to age 95 or age 90, whatever that may be. And so what you want to do is you want to run that projection out to age 95 and see what that benefit may be of taking Social Security a little bit later. But you want to look at, well, what does that look like at age 80, or what does it look like at age 75? Because if you delay taking Social Security, that's going to likely mean bigger withdrawals coming out of your portfolio. And so there's going to be a break even. We generally find that for most people, that break even is going to be about 10 or 11 years, whether you're delaying from 62 to 67 or from age 67 to age 70. But there is definitely going to be some break even. And then look at that. What does that look like at age 80 or 85 for that? The other thing too, if you're looking at doing Roth conversions, that's another thing too, where there's a little bit of a break even because you're paying some taxes on that Roth conversion at the time you do the conversion, and that's going to mean less money in your overall portfolio. Now, there could definitely be some very big tax benefits to doing those Roth conversions, but there might be a break even out into the future when that tax savings translates into more money overall for your portfolio. So you can see what that looks like. And if you're running this out to age 95, that may show very good, but you want to look at that. What does it look like at age 90 or age 85? So life expectancy is going to be another one of those. The next one is going to be using different rates of return in your different accounts. So we talk about the three primary tax buckets: your taxable brokerage or your non-retirement account assets, your traditional retirement account assets, and your Roth retirement assets. Now, in reality, those accounts should be invested very differently from one another. Your Roth accounts usually are going to be some of where your more aggressive investments are going to be inside that Roth account, and that may very well grow by a higher rate of return over the long run versus your traditional retirement accounts. Usually, we recommend, if you're going to have some more conservative investments like CDs or bonds, any kind of fixed income, that's going to typically be best inside of that traditional retirement account. So if you're using an 8% rate of return on your Roth account, but you're using a 6% rate of return on your traditional retirement accounts, and you start planning Roth conversions, those Roth conversions are likely going to look very good because you're moving money from an account that's paying 6% into an account that's making 8%, at least inside the software. And so that may show that looks very good. So what we do inside of our financial planning software is we keep the rates of return at exactly the same rate across all three buckets. And that way, when we do those Roth conversion analysis, we can really isolate what that tax benefit is of doing that conversion. And in reality, again, we're going to invest that money differently, but for purposes of analyzing that Roth conversion, we want to keep those rates of return the same. Especially if you start linking accounts to whatever software you may be using, sometimes they'll automatically import a rate of return based on the investments that you have inside that account. We see this a lot, even with our software, where a client goes on and links a bunch of accounts, and I start looking at the plan, and the next thing we know that, hey, some of these accounts are actually projected to grow at 9.5% because they're fairly aggressive. And so we want to keep that all consistent so we can really know what that true tax benefit is going to be. And then the last one is not running it through a financial planning software tool. So I know there's a lot of people that have built some really good spreadsheets, or they watch a lot of videos like this and they have a really good pen and paper kind of analysis, or their friend told them that they should do more Roth conversions and they should go up to this tax bracket or make sure that they don't go over the IRMA thresholds or whatever. But having it inside of a piece of financial planning software, I think, is very critical because there's a lot of things that are going to happen inside that software. Number one is, if it's a good piece of software, it's probably gone through some type of an audit process to make sure that the calculations and everything are spot on accurate, and that there's no missed numbers or anything like that inside the analysis there. There also should be some very good tax planning capabilities inside that software. And I think that's where I think a lot of financial planning software might fall a little bit short. It may use some generalized tax rates, or you might say that I think I'm going to be in a 22% or a 24% tax bracket in retirement. It may just calculate all of your income at that 22 or 24%. But in reality, though, we have a tax table that's a progressive tax system. We do get some deductions off the top that are zero tax. That's your standard deduction. And if you qualify for any of the other like senior bonus deductions and things like that, there may be even more on top of that, or itemize your deductions. Some of your money, whether you make $100,000 a year or you make $1 million a year, some of it's going to be taxed at 10%, some of it's going to be taxed at 12%. So there's more of an effective tax rate. I've been talking about that a lot in some recent videos here. But having a piece of software that can calculate that, and even your state taxes, if you live in a state like we we do in Michigan, where there's going to be some state income taxes, having a projection on what those state income taxes are going to be as well. And that's going to be really critical. So there's different levels of this. What we use is the eMoney financial planning system, and that is, I think, one of the best, maybe the best in my opinion, for being able to do this tax calculations and everything. And then having that software where you can go in there and say, what if I take Social Security early, or what if I delay Social Security? Let's throw in some Roth conversions. Let's change up our withdrawal strategy. What if we change up the amount of income that you need? That's going to be bigger withdrawals. And to be able to do that quickly and easily on the fly, and then have that piece of software calculate that for you, I think is going to be critical. And you really almost can't even do it without that software. So having a piece of software, very, very important here. So I'm Bill Lethman for MoneyEvolution.com to help you with a lot of this stuff. We have some great resources, totally free, over on our website at MoneyEvolution.com. We've got our tax worksheets that can help you really dial in where you're at within the tax brackets, targeting different things like IRMA or the 0% long-term capital gain tax bracket. We also have our retirement tax planning playbook, our Roth conversion playbook, and we keep coming out with new playbooks and new guides on a pretty regular basis here. We're kind of building out a little bit of a library there. So that's under our free resources section. And then if you'd like to learn more about how we can help you with a plan specifically, we have our Retirement Time Machine program. That's a one-on-one financial plan. It's a standalone plan that's not connected with where you choose to invest your money. So you can invest wherever you want, and we do the plan for you. And if you want to check that out, you can go to our website under the Retirement Time Machine. And if it's something that you want to learn more about, you can schedule a free introductory call with me. We can hop on a 20 or 30-minute call, answer some questions, learn about your situation, and see if it's a good fit for you. So again, I'm Bill Lethman for Money Evolution, and thanks for watching. I'll see you back in one of our next videos.